I. Calculate, analyze, and evaluate financial ratios to optimize financial decision-making. Financial ratio analysis is an essential treasury management tool used to evaluate organizational performance, liquidity, operational efficiency, leverage, and profitability. Treasury professionals calculate and interpret financial ratios to support strategic decision-making, improve liquidity management, and assess financial stability. Ratios provide meaningful insights by comparing relationships between financial statement accounts and identifying trends over time. Treasury teams use ratio analysis to evaluate cash management effectiveness, borrowing capacity, creditworthiness, and working capital performance. Accurate interpretation of ratios supports decisions regarding financing, investing, operational improvements, and risk management. Treasury professionals also compare results against industry benchmarks and historical performance to assess organizational strengths, weaknesses, and potential areas requiring corrective action. Liquidity ratios measure an organization's ability to meet short-term obligations using available current assets. Treasury professionals commonly analyze the current ratio, quick ratio, and cash ratio to evaluate liquidity adequacy and operational flexibility. The current ratio compares current assets to current liabilities, while the quick ratio excludes inventory to focus on highly liquid assets. The cash ratio measures the organization's immediate capacity to settle obligations using cash and marketable securities alone. Treasury professionals monitor these ratios closely because insufficient liquidity can disrupt operations and increase borrowing requirements. Effective liquidity analysis helps organizations maintain adequate working capital levels while minimizing excess idle cash and optimizing short-term financial performance. Efficiency ratios evaluate how effectively organizations manage assets, receivables, inventory, and payables to support operational performance and cash flow management. Treasury professionals analyze accounts receivable turnover, inventory turnover, accounts payable turnover, and the cash conversion cycle to assess working capital efficiency. Faster receivable collections and efficient inventory management improve liquidity and reduce financing needs, while effective payable management supports cash preservation. Treasury teams use these ratios to identify operational inefficiencies, evaluate collection and payment practices, and improve cash flow forecasting accuracy. Monitoring efficiency ratios over time helps organizations strengthen working capital management strategies and improve overall treasury performance through better utilization of operational and financial resources. Leverage and profitability ratios help treasury professionals evaluate long-term financial stability, debt capacity, and organizational performance. Common leverage ratios include the debt-to-equity ratio, debt ratio, and interest coverage ratio, which assess the organization's reliance on debt financing and ability to meet financing obligations. Profitability ratios such as gross profit margin, operating margin, return on assets, and return on equity measure the organization's ability to generate earnings from operations and invested capital. Treasury professionals use these ratios to support borrowing decisions, assess covenant compliance, and evaluate financial risk. Strong profitability and manageable leverage improve access to financing and strengthen the organization's overall financial position. From a CTP examination perspective, candidates must understand both the calculation methods and practical interpretation of key financial ratios. Exam questions frequently assess the ability to calculate ratios accurately, analyze trends, compare financial performance, and recommend actions to improve liquidity or operational efficiency. Candidates should understand the relationships between working capital, cash flows, leverage, profitability, and financial risk. Knowledge of industry benchmarking, ratio limitations, and the impact of accounting policies on ratio interpretation is also important. Treasury professionals must apply ratio analysis within broader financial decision-making processes to support effective liquidity management, financing strategies, and organizational performance improvement in dynamic business environments.